got this new audio device, which hopefully will improve the audio quality. It's a little bit echoey in here, so we'll try this. What I want to talk about today is of paramount importance, I think, to understand how markets sometimes work. And so what I want to do here for a minute, I'm going to blend in a chart of the S&P 500 to explain why December and January, so December 2018 and January 2019 and into February, have been so difficult. And I can tell you, speaking with a lot of high net worth and individuals and hedge funds and people that are active in the market and are really good at it, why they really didn't participate much or do much in December and January, and why it was so difficult. One of my core principles is that from a trading perspective, position durations of a few days to a few weeks, I will never hold a position through an earnings report, for example. So, or even through a major announcement, like maybe a major Fed decision. And this, for trades, for a longer term view, or even for a macro trade, I wouldn't mind keeping that on. So, let me blend in the S&P 500 chart here. And what you're looking at right now is this V-shaped reversal that we saw, a very sharp drop, which was the second leg lower, by the way, in 2018. The first leg started in October early October 18, and then we went sideways for a month and a half, 2 months, and then we dropped again into December. So we had about a 16-17% drop, followed by a massive rally that, as of this recording right now, measures about 18 to 20%, depending on where you take it and what you look at. Now, let's look at and focus very specifically on December. If you look at December, you can see how with the first few days we started to kind of roll over, and then things got really ugly. By the time we got into about the, let's say, 5th, 6th, 7th of December, I did my usual weekly calls around the desks or trading desks and things like that, and I noticed that basically everyone that I usually speak with, or actually the people that are a little bit outside that circle, they'd all closed their books for the year. And the reason was that they didn't want to risk anymore in 2018, and they were just kind of done because they didn't want to mess up their year. So being that, I looked around and noticed that I'm one of the few people that's still actually out there doing stuff. I wasn't actively trading because I wanted to wait for the Fed. The problem then was, by that time in December, we had to wait for the Fed. The Fed came out, I think the meeting was 18th or 19th of December. So basically you had to wait for the Fed because it was hugely important, that Fed meeting. Of course, the Fed then pivoted dovish. At that point, you were so close to Christmas, you couldn't really do anything because, again, a lot of people were out and it just didn't make any sense with thin liquidity and all that kind of stuff. The stock market drops right into the lows into Christmas Eve, which has literally never happened before. We come back December 26th. The market gives us a beautiful bullish reversal. That's that big green candle you can see following the absolute lows on the chart. But the problem is, no one's around. I look, all the fund managers, everyone I talked to was either skiing, they're at the beach, or they're taking off and being with their family, as they should at that time of year. With only a few days left in the trading year, who out there is really going to go and commit a lot of capital? I can tell you very few people really did. It was a lot of machine trading. Keep in mind, 80-90% of volume these days is automated trading. It's not actually humans. So then the year finishes off. Market rallies quite strongly into the last few days of the year. But then we come into the new year, right? And usually it takes people a few days to 1.5 to 2 weeks to actually get back into the new year, shake off, sort of, come back from vacation and things like that. So I can tell you most fund managers didn't really come back until the second week of January. At that point, the market had already rallied 8, 9, or 10% or something like that. No one in their right mind at that point commits any fresh capital for the near term at that point. So there really wasn't anything you could really do from a high probability perspective, at least through the lens that I look at it. And most people that I would talk to would agree with that, just from a probability perspective. At that point, you are so close to earnings season kicking off, you couldn't really do much either. Again, sticking with the rule that I don't want to put on trades. And again, I mean trades of durations of a few days to a few weeks. So then early December, or mid-December, January comes around, banks start to report earnings. The banks rally so hard, you couldn't really do anything that you do, because they had just rallied strongly. They rallied even more after the earnings, and then they got extremely overbought. So there was really nothing you could do there. At that point, you couldn't touch the banks anymore because they had just rallied so strong. You had to basically wait for other companies' report. Basically tech, industrials, consumers, all those kind of stocks. And so you had to wait even more. And before you knew it, the stock market was up 15, 16% in a straight shot, and basically from a high probability perspective, unless you wanted to chase momentum on an intraday basis, which is another story, and that's another type of strategy, which I think is very risky over time, you really couldn't do a whole lot if you wanted to actually have a sound strategy. The good news is that now finally, I think we are getting into, and these are famous last words, so take this with a grain of salt, but I think we're finally at a point where we're going to see more of a two-way market, buying opportunities as well as selling or shorting opportunities. We buy with using stocks or options or both, obviously. So I think we've had a really difficult, almost an anomaly type of environment behind us. 16, 17% drop in December, followed by so far here, as of this recording here, 18, 19, 20% rally, looking at the S&P. Almost unprecedented in terms of the duration and the steepness of these moves. But I think now it's going to get easier going forward, and I'm looking forward to that. And so just so you know, I also shared this view here today with our Clubhouse paying members and coaching clients and all that, and institutional guys and everything. But I did feel like this was an important message to get across and educate also the broader audience. So I hope you take this for what it's worth. Hope you find it useful. And we'll be back next week with a further announcement on our Arizona workshop, our springtime stock and options summit. So stay tuned for more information on that. Until then, take care.